We are live, sir.
Right. Say good morning, friends. See, we are on to um, advanced accounting, accepting for application of accounting standards. On the other day, we have started with, or we have started, in fact, with consolidated financial statements. Then we have tried on to dissolution of partnership and internal reconstruction, liquidation, a portion, and that's it. So that was the reason as why we had this additional class for today for about 2 hours. The areas that we will cover during this 2 hours session could be amalgamation, conversion and sale of firms, ESOP, buyback, amalgamation of companies. We did only one purchase consideration, maybe one extra problem we will do. Then in liquidation one. So banking companies we will touch on to these, and NBFC. With that we will close for the session, so that we get the satisfaction of touching all the topics within the time frame given for this particular rapid revision. So in fact, it is fast track, not even rapid revision, is a fast track. But at the same time, whatever we do, we need to know the logic and why we are doing it, and that is very important, because under examination conditions, see, there may be some twists and turns, there may be some surprises. We should know how to handle it. So therefore, we will start with so maybe amalgamation, conversion, and all that. Amalgamation and conversion we will take up. And we are going to have SICASA's last problem that we have tried. Every bit is recorded here, and we are opening a separate file for that. So now let me just take up on to amalgamation of firms and sale to a company. In fact, that was the title, no? Sale of partnership, conversion, amalgamation. Okay. See, now let us know about what we are expected to do. So we all know that amalgamation of firms would mean two firms will get merged. Conversion and sale of partnership firm, where the form of entity, that being firm, will get converted into limited company. Now let us just take up firstly amalgamation of firms. Amalgamation of firms, in which there are two things that we have got to do. One is closing the old books of the amalgamating firms, and the other one is opening the books of the amalgamated firm. There is a new firm. So what are the procedures that we are expected to do for the old firm? So it is very clearly given in our institute study material. We don't have to just have any other shortcut, because the institute material is itself is a shortest cut. I will not say shortcut, shortest cut. They have made it amply clear even for a layman. And even when I was a student, I was only an average student, but I could just easily understand. So in the sense that language are all very, very simple. Each firm should prepare revaluation account relating to its own assets and liabilities and transfer the balance to partners' capital account in the profit sharing ratio. This is similar to that of admission, retirement, death of a partner. Whatever we have studied in the foundation stage or at a higher secondary stage, we have got to do that. Then entries for raising goodwill should be passed. So normally we have the restriction of raising this goodwill only in limited company, because AS 26 will prevent you from boosting intangible assets, self-created assets. So therefore, there we have some restriction, but not in partnership. Then assets and liabilities not taken over by the new firm should be transferred to capital account in the ratio of their capital. So not all assets of the old firm, they will be in a position to take it over, there could be some assets and liabilities which will not be taken over. That should be transferred to, taken over by the new firm, should be transferred to the capital account of the partners in the ratio of their capitals. Why? Because they have contributed money to create those assets and liabilities, and it is not a profit. Therefore, profit sharing ratio should not be used. Profit sharing ratio, from the very name itself, you understand that only profits are to be shared in that profit sharing ratio. And since it is not profit, since they represent their capital, because asset minus liability is what you call it as capital. Therefore, we are expected to use capital ratio, and the new firm should be debited because from there they got to receive something, and therefore which will be in a receivable form and should be debited with the difference between the value of assets and liabilities taken over by it. The assets should be credited and liabilities are to be debited because you have to close it. Then partners capital account should be transferred to new firm's account, and new firm's account will automatically agree. These are the steps that we are expected to take up in the books of the old firm. So here also 5 steps, but in this case 5 steps. Step number 1, revaluation to goodwill, assets and liabilities not taken over in capital ratio. New firm shall be debited by transferring assets and liabilities there. And lastly, transfer the capital account of the partners to the new firm's account, and new firm's account will automatically agree. So then comes opening in the books of the new firm. So here is a place where you have to pass a religious journal entry, and which will not have any impact at all in terms of that you got to learn something new, that being debit assets and credit liabilities and credit individual partners capital account of the closing balance of the older firm. Thereby, you just find the matter is getting over smoothly. See, now, even though we have got to cover a lot, today I will not be in a position to work out manually. So, we will use institute study material and their solution itself for explanation so that we cover maximum during this extra time that they have provided. So B and S are partners of S and company sharing profits and ratio in the there is losses in the ratio of 3:1. S and T are partners of T and company sharing profits and losses in the ratio of 2:1. On 31st of October X1, they decided to amalgamate and form a new firm BST and company, wherein B, S and T would be partners sharing profits and losses in the ratio of 3:2:1. Their balance sheets of S and company and T and company they have provided, where you have cash in and cash at bank due from T and company and due from X and company, other data, stock, furniture, vehicles, machinery, and building. On the left hand side, due to X and company, due to S and company, other creditors, reserves, capitals, BST. Then amalgamated firm took over the business on the following terms, and of goodwill of S and company was worth 60,000 and that of T and company 50,000. We don't find any goodwill there. Goodwill they have asked us to create. Goodwill account was not to be opened in the books of the new firm. The adjustment being recorded through capital account. So we have got to do all this exercise in the books of the old firm. Building machinery and vehicle were taken over at 50, 90 and 100,000 respectively. Provision for bad and doubtful debts to be carried forward at 4,000 in respect of S and company and 5,000 in respect of T and company. You are required to compute the adjustment necessary for goodwill. Pass necessary journal entries in the books of BST and company, assuming that the excess deficit taking T's capital account with reference to share or to be transferred to the current account. See, now let us just take up the adjustment, that being goodwill. So goodwill has got to be raised for both the companies and they got to be written off. And the raising should be done in the old ratio and writing off should be done in the new ratio. See, now that part alone, I will be in a position to crack it out. See, now let us just take up raising B, S, T and total. And what ratio we are using for the purpose of raising. So 3:1. This is with reference to S and company. The other one being T and company. Raising 2:1. And writing off, this is BST and company, writing off in the ratio of 3:2:1. Now, what is the amount that we have got to raise? 60,000. So, goodwill 60,000 debit, credit in the ratio of 45,000, 15,000 dash. And in this particular case, 50,000, 2:1 ratio. Say very odd one only you will be getting 50,000 divided by 3 into 2. So it is 33,333, 16,667. So where we are expected to write off goodwill, where credit goodwill and debit is to be given to 1,10,000 divided by 6 into 3, which is 55,000, and divided by 3 multiplied by 2. So it is 36,667, and that should be taken up as, sorry, and I think I've just taken up into a wrong side. 18,333. So because of this, the scheme of journal entry would be coming out like 10,000 negative. So these are all credit, so debit. So now let us just affect the total. 15,000 plus 33,333 minus 36,667. 11,666 credit, and 18,333 minus 16,667, that comes to 1,666 debit. The scheme of journal entries would result in this particular form. That is what they have just given. So whatever we have just done, they have done vertically, horizontally. That is the maximum difference that you have. So adjustment to that effect is made in the very first working note. I hope that things are very clear for you. So this is good total, or you can say it is goodwill. So now the goodwill account will show nil balance, but the scheme of journal entry that you have got to make would be debit B, debit T, credit yes. So 10,000 you got to debit, 1,666 you got to debit, 11,666 you got to credit. This is what you have, right? Now the question is about, there is answer only to those questions. You don't have to just close the books of accounts. They asked question, compute the adjustment necessary for goodwill. Matter over. Next, pass the journal entries in the books of BST and company, assuming that excess deficit shall be taken into T's capital as a base, and the rest you can take it up as current account figures. There will be some shortfall, and we are expected to take up all those in one shot. So we don't have to even take up the particular case on item by item basis. We could have as well done in one stroke itself. I'll tell you what do you mean by one stroke. Our institute had just taken two different ways. They have said these are the changes that we have got to make, right? So cash in hand, you got to take it up. Cash at bank, you got to take it up. Due from TN company. So between TN company and SN company, you have mutual owings. So when these two firms are getting merged, you don't have to carry both receivable as well as payable, so you can leave it off. Then due from XN company 30,000, there is some other company, neither SN company or TN company. So to the same company, one of the two have to pay 40,000, and 30,000 there is a receivable. You can knock it off and make only 10,000. Other data you can make it out as 1,80,000. Stock and 130, furniture, vehicle, machinery, and other creditors. Reserves, of course, will get distributed to them, and thereby you can offer credit to B, S, and T. And what is that particular amount that we can update it later? So always remember, our institute did this for the sake of clarity. Firstly, they have just done all this exercise separately, and to 165 650, 165 750, and 95 250. How did they know about the partners are to be credited this much, because they have prepared the capital account in a short form where they have credited and the profit or loss they have just done. So this can be done, but under examination condition, we don't have that much of time to do that. So therefore, I suggest in this fashion, so you don't waste your time, and I will suggest you that you try it like this way. You try like this way. So we are passing journal entry, no? So how we pass a journal entry, here we will show. So journal entries in the books of BST and company, correct? So what you do is that debit cash, 15,000. Why should I do it separately? Since I am going for an amalgamation, in one journal entry itself we can pass. So debit bank, 35,000. This TN company, I said mutual owings, you got to that is you got to ignore. Debit debtors, 180,000. Debit stock, 130,000. Debit furniture, 13,000. Debit vehicles. So these items are got to be, these items are to be taken up at new value. So that we have got to check up. Building machinery and vehicle. But there is no furniture there. So up to furniture we have taken up. Vehicle has got to be taken over at 100,000. Correct? Debit machinery. Machinery, what is the value at which it is to be taken up? Machinery has got to be taken up at 90,000. Then building. What is the value at which building has got to be taken up? Building has got to be taken up at 50,000. Are you understanding? So you make the job very easy and fast. Now, on the other side, I will take up the credit due to X and company. So if you take up the debit and credit, credit is heavier by 10,000. I will show only 10,000 there. The next credit, other creditors, 118,000. Correct. 60 plus 58. So then here they mention provision for bad and doubtful debts 5,000 and 4,000 and 5,000. So credit, provision for bad and doubtful debts 9,000. Correct. That is also part of revaluation only. Then credit B, credit S and credit T. So how much we should offer credit to B, S and T, we can work it out easily. So we have partners B, S and T. The ratio that we got to adopt, here they have not asked ledger accounts. 3:1 and 2:1, 2:1. S is the common partner. So capital account. So we can take their capital accounts. Capital accounts on them being 120,000, 80,000, and from here 100,000 and 50,000. Reserves. So reserves 25,000, 3:1. 25,000 divided by 4, 6,250 into 3, 18,750. In this particular case, 2:1, 50,000 into 2 divided by 3. 33,333, 16,667. Check it up. Correct. Now we will take up on to profit on revaluation. How much was the profit on revaluation that you were having? So building and machinery. Building 50, 25 taken apart 50 and 75 taken apart 90. So thereby you have 25 plus 15, 40,000, 40,000 minus 4, 36,000. So revaluation profit 36,000, 36,000 divided by 4, it is 27,000 and 9,000. And in the other case, this 80,000 is taken up at 100,000. So 20,000, 20,000 minus 5,000, 15,000, 15,000. So 10,000 and 5,000. Only this much of change. So what should be the closing figure? So 120,000 plus 18,750 plus 27,000. So 165,750. 165,750. Then in this particular case, 180, 6250 plus 33,333 comes to 39,583 and 19,000. Now let us just sum up. Two 38,583. 238,583. Then this being 50,000 plus 16,667 plus 5,000. 71,667. 71,667. Look into the journal entry, it is going to be the same. 71,667 along with the other one. So now you just find the capital account of the partners on account of goodwill also taken up. Then knocking off mutual owings, all that we have taken up. Now we shall find out how much is the capital account and how much is the current account. See, now let us just take up that. So partners B, S and T, where you have the figures that you have brought. Now you can affect the total of your debit and credit. So just as a matter of anxious CA student, 15,000 plus 35,000 plus 1,80,000 plus 1,30,000 plus 13,000 plus 1,90,000 plus 50,000, all that comes to 6,13,000. And on the credit, 10,000 plus 1,18,000 plus 9,000 plus 165,750 plus 238,583 plus 71,667. All that comes to 6,13,000. So your debit total and the credit total dual aspect entry, that is dual aspect concept is getting over. So capital brought in 165,750, 238,583 and 71,667. Correct? That we have just done. So the goodwill adjustment entry wherein we have debited B and T. So 10,000, 10,000 and 1,667. So these are all debits now. So therefore we will 11,667. Though it was 66, I have adjusted for rupee 1 to get the effect that is where you get a round figure. So now what is the total before the adjustment? So it is 165,750 minus 10,000. Why minus? Because we have debited the capital. So 155,750 and 238,583 plus 11,667, that comes to 250,250, and this is going to be 70,000. Correct? So after the goodwill adjustment, when you are taking yes as the base, that is what they have mentioned. When you have yes as the base, whose base? Sorry, T as the base. When you consider T as the base, when profit sharing ratio were to be 3 by 6, 2 by 6 and 1 by 6, what should be the firm's capital? So firm's capital account should be 70,000 into 1 by 6, divided by 1 by 6. Divided by 1 by 6. So 70,000 into 6, that comes to 4,20,000. So that means fixed capital system is going to be 4,20,000 or 420,000 into 0.5, that comes to 210,000 divided by 3 multiplied by 2. So it comes to 140,000 and it is going to be 70,000. Correct? So the difference will be taken to current account. So I am supposed to have 210, but I'm having only 155. So 210 minus 155, 750, I'm getting 54, 250 debit total. So 250, 250 is my total, whereas I'm expected to have only 1,40,000, lakh and 10,250 credit balance, and it is nil. What exactly was the question? They did not ask you to prepare balance sheet. Our matter is over. All that we have just done is right. Completed. So institute might just do it for clarity purposes, separate ledger account, separate working and all that. But we have just got it done just like that. So therefore, you need to know us how to work out quickly and at the same time ensure accuracy. So speed and accuracy are very, very important under examination condition. You cannot forego speed for the sake of accuracy. You cannot forego accuracy because of the speed. You have got to have both. Right. So now that this problem is getting over, so now you could just see as how institute had just developed and how we have just done that. So now coming back to this. So now I would just say that resolution over amalgamation conversion. See, at least one problem, at least we have just done that. No. See, now let us just take up something on ESOP. So now let us just try this ESOP there. Yes. So see, now let us just understand what is ESOP, employee stock option plan. What do you mean by employee stock option plan? See, we understand that in order to retain talent, where companies cannot forcibly hold anybody. So they can offer some incentive saying that if an employee continues in employment for a minimum period of say 3 years, they are eligible to subscribe for shares in the company, and this sort of announcement they will be making at a point of time which you call it out as a grant date, and there will always be an option provided to them. So it is not compulsory that they got to subscribe. So some people might just feel like it is a gambling, so therefore they will not participate. Some people may have finance problem, liquidity problem, because they got to invest. It is not given free. Many are under the impression that ESOP is something given free of cost. It is not sweat equity. It is given for money. So therefore, employee need to have some amount of liquidity to subscribe. So some problem, there is some employees may face some problem for not taking it up. So therefore, they may not be subscribing at all. So as far as ESOP is concerned, as far as ESOP is concerned, that is share-based payment is concerned. I will put it like this way. Share-based payment is concerned. There are three schemes that you have: employee stock option plan, employee stock purchase plan, and share appreciation rights. So share-based payment can be classified into three as ESOP, employee stock purchase plan, stock appreciation rights. What do you mean by employee stock option plan? So in this particular case, there is an option that is provided to you, provided to employees, where they are expected to subscribe. So either they can subscribe or they can subscribe or allow them to lapse or allow to lapse. Allow to lapse. See, but understand one important thing. Some of the employees who would be interested to participate and bring some amount of extra liquidity to them may find it difficult because of the liquidity problem that they have. Liquidity issue may be there. So therefore, they would be happy to participate if liquidity is not there. So you have stock appreciation rights where you have two things, where cash, the other one is cash or stock. That means if the share prices are moving up, then the exercise price which was promised to the employees, then the difference between the price quoted in the market and the subscription price, the difference is going to be a profit if they subscribe and sell. Since they don't have the liquidity to subscribe, so company will consider that they have subscribed and they have sold it in the market, and thereby they capture the difference between the market price and the agreed subscription price, which you call it out as exercise price, and they consider that as profit and distribute to employees. So that is where you are under the impression that employees are not having liquidity at all. But not all will have that liquidity problem. Some may be born rich, still be in employment just for the sake of society. They will be going for an employment. I know many people like that. See, I know a gentleman in Kerala who is having rubber estate, and he being the only son in that particular family, but his family had given some space to one PSU. Their land was acquired, and they got an agreement saying that their son should get employment. So that has become a part of law only. See, that problem which the item that I'm just talking about is that though he was in a middle position, middle executive position, because he did not qualify much. The point what I want to tell you is that if there were to be any such scheme, the person is not having any problem. He got all his three daughters married just like that, because his rubber estate income was so rich that even the chairman of that particular PSU may find it difficult to come in a Mercedes Benz. But this gentleman came in Mercedes Benz every day, though not a very big executive, but he is a very simple person that way. That is, Mercedes Benz is simple. The point which I want to tell you is that for him, cash is not a problem. He is having money, so therefore he can subscribe to stock. So stock appreciation rights might come where you can understand that the company wants only cash to be paid. Yes, and they can also give the option to the employees that stock can be subscribed. Why I got to stay put there to discuss is that when cash is to be paid, it becomes a liability. It becomes a certain liability. Whereas when stock is there, this is also a liability, but here there is one estimate that I got to make. What do you mean by estimate I got to make? Like ESOP, I got to estimate because I do not know how many of them will subscribe. I got to judge. See, when ball is hit and when it is going at the top, so the commentator will say most probably it will be caught. Within few seconds, they will say yes, it is caught or dropped or getting that in no man's land, or it may be a no ball. It could be a variety of things. So there will always be an uncertainty associated with the stock options, but there will always be a certain liability in case of cash. So therefore, the usage of the terms in journal entry itself will be differing. So therefore, at the very initial stage itself, I thought I will briefly discuss. Okay. So that is what you have: ESOP, yes, ESPP, stock purchase plan, and stock appreciation rights. So previously we had a guidance notes issued by ICAI. Now, after the advent of Ind AS, we have Ind AS 102 with respect of this share-based payment. So now let us just know about the technical terms that we will be using. So there will always be a date of announcement. Announcement date will be there. Announcement date, which they call it as a grant date. There will be some period that they provide. So eligibility criterion, which you call it as a vesting period. This is the date on which they get the eligibility, vesting date. This period will be referred to as exercise period, exercise date. So after this, it is getting lapsed. So whatever the employer is incurring some cost associated with that, he has got to amortize. And even this period also, where you have got to bring about some adjustment or rectification. Adjustment has got to be carried out. So how this matter will be taken up? This is what I told you, no, the guidance notes that institute had just developed it. That is what they have given exercise price. So all that we will definitely be knowing. So since it is a fast track, I'm not in a position to share beyond this. Now let us just know about how to solve the problem. So a company has its share capital divided of rupees 10 each on 1st of April. Export granted 10,000 employee stock option at 40 when the market price is 130. Fair value of the option calculated using the option pricing model is 90 per option. The option were to be exercised by 15th of March X2 and 31st of March X2. The employees exercise their option 9,500 only, and the remaining option lapsed. So within 1 year itself, they have just done that. So on 15th of March, what had happened is that 9,500 shares at the rate of 40, they have collected this much of money. And you know that 9,500 and each share having a face value of 10 offered credit with 95,000. The remaining amount has got to be taken up for security premium, and the difference will be taken up to employee compensation expenditure. So that way the employees are provided with what? That much of benefit, which becomes an expenditure. So illustration number 1, we have market price at 130, exercise price at 40, and the difference is going to be loss, that being 90. And we all know that there is another way of looking to the subject matter, that we have 130, face value 10, security premium 120. So now we have got to take into account both. Now how do we take it up? Debit bank 9,500 into 40. Debit employee compensation 9,500 into 90. Credit equity share capital 9,500 into 10. Credit security premium 9,500 into 120. So these are all debits, these are all credits. So how much is that? 9,500 into 40. 380,000 rupees in thousands. Divided by 40, multiplied by 90. That comes to 855. So 95, 9,500 into 120, that comes to 1140. So this is the scheme of journal entry that they have provided. And this employee's cost should be transferred to profit and loss account, debit P&L account, credit employee's compensation, 855. So we are very happy that grant same year, vesting same year, and exercise all same year. So therefore, same year, there is no amortization effect that you could see. Is that clear? But to start with, let us just know what is ESOP. Okay. Then now you have, with one more illustration, we can wrap it up. Or maybe one SAR we can try. So ABC Limited grants 1,000 employees stock option at the rate of 40 when market price is 160. The fair value option calculated through an option pricing model is 120. The vesting period is 2.5 years. And the maximum exercise period is 1 year. 300 uninvested lapse on 15x2. 600 were exercised and 100 lapse at the end of the exercise period. Give journal entry with suitable narration. So this is an ideal problem we can understand as how amortization will take place. So here we can say, we will put it like this way. 1,4. So you can see it is 1,421. We can take up 1,422 and somewhere here 3922. This is the vesting period, and this may be 1,423 and 3923 is going to be the period of exercise. Vesting period, exercise period, and lapsing period. 1,000, which with, that is they started with 300 unvested options lapse on 15x2. So x2, so somewhere here, some people would have left. One 522, 300 lapsed. Then 600 exercise by 36. X3 in which it got exercise, correct only. 36, 23, 600 exercised. Say after 300, it should be 700. So lapse came for after this 100 lapsed. Okay. See, now we understand year 2021, 21, 22, 22, 23. What is the fair value of option? Fair value of option is going to be 1,000 multiplied by 120. That is the amount of loss that company will be suffering. So fair value of option is 120,000. So what is the cumulative ratio? I'm going to consider something like how many years lapsed to how many total years that you have, 2.5, 2.5. So cumulative ratio, cumulative amount. So 1,20,000 divided by 2.5 will give you 48,000. Current year figure is going to be 48,000. So you will not be in a position to understand immediately. Please just don't worry about that. So in the next year, it is also 120,000. Now by that point of time, 2 years lapsed out of 2.5. Now you can consider easy 2 divided by 2.5 into 1,20,000. That comes to 96,000. And we are having 48,000 as current year's expenditure. So that is what you have. So 1,000 stock option into 120 divided by 2.5, that is what we have just got. And that they have transferred. In the following year, once again 48,000. As how it had just come, it is because of the difference between the two that 48,000 had just come. Correct. In the next year, so it is 120, but here 300 lapsed. So therefore, we are expected to adjust that. So for 700 only, I should take up. So 700 into 120. So it is 700 into 120. That comes to 84,000. So 2.5 divided by 2.5, 84,000. So therefore, what we are expected to do is that the difference between the two is 12,000, which we have got to transfer from ESOP outstanding to general reserve. So to that extent, we are expected to transfer to general reserve from ESOP outstanding. Now let us just know about what scheme of journal entries that we are expected to pass. Year 2021, debit employees cost, credit ESOP outstanding 48,000, and debit profit and loss account, credit employees cost 48 and 48. Right. Then in year 2, 21-22, debit employees cost of 48, credit ESOP outstanding 48, debit P&L, credit employees cost 48. Then in year 22-23, this would have happened when employees have left employment. So debit ESOP outstanding, credit general reserve for that 12,000. There is no amortization that they would make. Then that point of time, in their books of accounts, they got to close. In the next year, exercising is done. So year 23-24, year 23-24, right? Year 23-24, they got debit bank from how many? 600. 600. Now we can work out like the last problem. Market price would be 160, let us assume. Exercise price 40 and loss 120. Market price 160, nominal value, face value. They have not mentioned what is the face value. Let us assume it as 10. Security premium 150. I don't know as whether they have just done that. Yes, they have taken up at 10 only. So 600 into 40, 24,000. Debit ESOP outstanding. 600 into 120, 72. Credit equity share capital 600 into 10, 6. Credit security premium 90. It is 600 into 150. Right. And you know that there is going to be a lapse, and that lapsing portion we have got to debit ESOP outstanding for how many? For 100 lapsed. 100 into 120, 12. Credit general reserve 12. So this is what you just understand. See, all of you, please understand one important thing is that your basics should be strong. So you just don't worry. All questions in the examination are not complex questions. There will always be some soft areas that you will be having, and we have got to do that. So therefore, you just don't get frightened at all. When we are passing, we will pass. And just because you tend to be anxious, being anxious, you will not get results. And that will only reduce your performance. This is my own experience, that whenever we are anxious, our performance will normally be down. So therefore, leave that anxious and be cool, and definitely you will get it right. Okay. So 2 problems you have just done. Now going back to this. So we have just done dissolution, amalgamation, and ESOP. Now we will take up buyback of securities. So buyback of securities, we will take it up. So you know that Section 68, 1 of the Companies Act, where they allow buyback of their own shares out of free reserves or their security premium or proceeds of any shares or other specific securities. The buyback of securities, any financial, shall not exceed 25% of the total paid up capital in that financial year. And whether they can do this frequently. The minimum gap of 1 year in a payback from the last one, the gap between the two buyback should be 1 year. Then the ratio of capital owed by the company is not more than twice the capital and its free reserve after the buyback. So there will always be checks and balances. You cannot be just doing it as you like. And we do have equity shares with differential rights. See, what is the entry that we are expected to pass for the purpose of buyback? So you got to consider buyback by taking it up as an investment. Now let us just see as how the first problem is handled there. Illustration number 1. They have given you the share capital, reserves and surplus, long-term borrowings given, trade payables given, and property, plant and equipment, non-current investments, current assets such as inventory, trade receivable, cash and bank balance they have given. They have given the breakup of capital as so much is equity and so much for preference. They have given you capital reserve, revenue reserve, security premium, P&L account, and long-term loan and PPE net carrying amount they have given. The company passed a resolution to buy back 20% of the equity capital at the rate of 15 per share. For this purpose, it sold investments of 30 lakhs for 25 lakhs of rupees. Sold of 30 lakhs of investments for 25 lakhs. So that means don't go by the reserves and surplus as you find just before the sale. So non-current investments which were sold resulted in loss. So therefore that loss has got to be knocked off. Your free reserves and all that is getting reduced because of that loss incurred on sale. So the first scheme of journal entry is that. Then premium buyback, they have just mentioned that 20% of the equity capital. So 20% of that is going to be 60,000. 60,000 into 15. Um, 60,000 into 15 is going to be 900,000. So that 900,000 will be the outflow of cash debiting to equity capital. Then premium on payback is going to be 300,000, and thereby the money is being paid. Then what exactly we are expected to do? The premium on buyback, like premium on redemption, that has got to be adjusted against security premium, because very rarely security premium is being used. So try to use to that extent, and we are expected to create capital redemption reserve to the extent of dent created in the capital on account of buyback. So that is made good by transferring from revenue reserve to capital redemption reserve. So that becomes a simple question. So please be careful. There can be a 4 marks question or 6 marks question on buyback, and go prepared for that. So try doing the problems as whether it is worked out illustration or a book back. So go prepared. Our institute will just solve, or will be asking you to solve such simple problems only. There will always two tough questions will be there, two moderate and two simple question will be there. So what institute is expecting, at least the simple question the student should attempt, so that they get that 30 to 40, and moderate level problem when you try, you will just cross over more than 50. And once you are successful with that, and when you are attempting the tough problems, what people call, you will just get 70, 80, and even 90 also. 90, more than 90 is also possible. I've seen students securing 100 out of 100 in accounting paper, and even on advanced accounting paper. So all the very best. I might forget to tell that, but we do have some more sessions, some more hours. So I think 1 more hour is left there, and a similar such journal entry only. See, now I would just say that we will just go to next one: buyback of securities, equity shares with differential rights we have done. Amalgamation of companies, we have done only one problem, that is for purchase consideration. So now let us just try that amalgamation of companies. Amalgamation of companies, we will take up a full-fledged problem. I thought I will just try out so that we have our fear, whatever, getting removed, so that it becomes very easy for us to take it up in the main examination. So now let me just check up. Is that a full-fledged question? Yes, it's a full-fledged question. Now let us just take up that and bring that confidence into you. Okay. See, now let us just try that particular question. Illustration number 7, we will take up, my dear. The following balance sheets are given on 31st of March 19x1. Equity and liabilities, share capital, Best Limited 20, Better Limited 10, reserves and surplus 10 and 8, current liabilities 20 and 2, total 50 and 20. Property, plant and equipment 25 and 15, non-current investments 5, current assets 20 and 5, total 50 and 20. The following further information is given. Better Limited issued bonus shares on 1st of April X1 in the ratio of 1 share for every 2 shares held out of reserves and surplus. It was agreed that Best will take over business of Better on the basis of latter's balance sheet, the consideration being the form of allotment of shares in Best Limited. The value of shares in Best Limited was considered 150, and the shares in Better Limited was valued at 100 after the issue of bonus shares. The allotment of share is to be made on the basis of these values. Liabilities of Better Limited included 1 lakh due to Best Limited from purchases on which Best Limited made a profit of 25% of the cost, and the goods of 50,000 out of the said purchases remained in stock on the date of the above balance sheet. Make the closing ledger in the books of Better and opening journal entries in the books of Best, and prepare the balance sheet on 1st of April X1 after the takeover. It's a very nice question where you have purchase consideration computation, ledger entries in the books of vendor company, and acquisition entries in the books of purchasing company, and creating a balance sheet. So very much an appropriate one. So now let us just take up here the first adjustment, 1 for every 2 held reserves and surplus. So in this There is reserves and surplus. Now let's just go through that. So where they have just given 1 for every 2 held. So now let's just take up the computation. Illustration number 7. So number 1, equity share capital of better is what? Where you find it is 10 lakhs. So 10,000 shares at the rate of rupees 100 is comes to 10 lakhs. Correct? Bonus issue. Bonus for 1 for every 2 would mean it is going to be 5,000 shares at the rate of rupees 100. It is going to have 5 lakhs increased. So it is going to be 15 lakhs. So from reserves and surplus. Reserves and surplus before, prior to that, it was 8. On account of bonus utilization, 5 lakhs reduction, and now it is going to be 3 lakhs. So first adjustment is over. It was agreed to take over business on the latest balance sheet. The value per share of Base Limited was considered to be 150, and the value of that is considered to be 100 after the bonus issue, and allotment of shares were made like this. See, now purchase consideration is on net assets basis. So though they have not mentioned as net asset, but the value of the share they have mentioned. So how do we examine this purchase consideration? Now let us just solve it this way. Number of equity shares of bidder. Now it is going to be 15,000 after bonus. Value per share of bidder 100. Purchase consideration value is 15 lakhs. Settled by issue of shares in best at the rate of rupees 150. That means number of equity shares of best to be issued will be 10,000. How come? 15 lakhs divided by 150. This is one way of looking into this matter. So I would say it is alternative 1. Alternative 2. What is alternative 2? So exchange ratio is equal to value per share of vendor divided by value per share of purchasing company. This is the formula. 100 divided by 150 is 2 by 3, or 2 equity shares of best is equal to 3 equity shares of better. That is what it is saying. 2 equity shares of best. That is 2 into 150 equal to 3 into 100. Both are having same product, but with different factors. So therefore, number of equity shares to be issued will be 15,000 into 2 divided by 3, which is equal to 10,000 shares. Correct? In whichever way you are arriving at, the answer should be same. So now, for a sort of a presentation which I would like to make, serial number, beneficiary, mode, calculation, and purchase consideration. Number 1, beneficiary equity shareholders, mode 2 for 2 equity shares issued for every 3 shares, equity shares held. Calculation 15,000 into 2 by 3 into 150, 15 lakhs. So the first question is over. Allotment of is this much. So how much is the purchase consideration? Purchase consideration is given as 15 lakhs. So how they have discharged, they have not taken much. What should I say? Focus on to that. Just like that, they have written. Now that matter got over. 1, 2, 3. 3 matters got over. Now this is with respect to liabilities taken over. There is some mutual owings between them, and there is unrealized profit there. All that will be focused only in the books of the purchasing company. Now they are asking us to close the books. What are the steps that are involved in closing the books of accounts? Number 1, transfer assets and liabilities taken over. See, there will always be a difference between dissolution of firm and company. In the case of dissolution of the firm, I recommend all assets and liabilities of the firm should be transferred to realization account. Correct? Because some of the assets will be sold, some of the assets will be taken over, but all assets will be disposed of. Whereas, in the case of a limited company, you are expected to transfer assets and liabilities taken over. Assets and liabilities not taken over, you should not transfer it to realization account. Open separately ledger accounts for them and dispose them off, and profit or loss on that particular item should be transferred to realization account. Transfer assets and liabilities taken over to realization account. Step number 1. The next, record the purchase consideration that is due. Then receipt of purchase consideration. Then number 4, distribution of purchase consideration. Transfer assets and liabilities taken over to realization. Record the receipt of purchase consideration. Receipt of purchase consideration, distribution of purchase consideration to beneficiaries. Transfer profit or loss on realization account to equity shareholders account, which will automatically agree. These are the 5 steps that we are expected to take up. In case of purchase consideration, you have lump sum, net payments method, net assets method. On the other day, we have discussed, so therefore I have not discussed it today. Ledger accounts in the books of vendor company, we have not discussed, so we are discussing it now. Correct? Now let us open ledger accounts. Number 1, realization account. So they are not mentioned in the problem that they are not taking over assets and liabilities. So therefore, we will transfer all assets and liabilities there. Then to equity shareholders account. 3, West Limited account. 4, shares in equity shares in West Limited. Now let us just take up one by one. Capital to equity shareholders 15, 10 plus 5 by reserves and surplus 8 minus 5, 3 by current liabilities 2. Number of items are not that much, so therefore I am just doing it simultaneously, both word and the amount. 15 to current assets 5. First step over. Transfer of assets and liabilities to realization. Record the purchase consideration by BIST to realization 15. Over. Record the receipt of purchase consideration to BIST by equity shares in BIST 15. Try as much as possible expressing in thousands and lakhs. Don't write too many zeros. Save time. Put rupees and lakhs. Matter over. They are doing like that. No. Why? What is the problem? Do like that. See, some students write 0, 0, 0. And that spirit of 0 will come to them. Try as much as possible. Reduce it to rupees and lakhs, thousands, crores, etc. Distribution. Now I will distribute to equity shareholders. To equity shares in BIST. So we have just done 4. Transfer of profit or loss to shareholders account by equity shareholders account 3 to realization 3. Now ledger entries books over. The last one. So here they open, transfer, all that not required. What we have done is the best. These are all two goody type of things that they are doing. So whatever realization account that we have opened, that is correct. Now in the books of BIST. Mutual owings and all that we will eliminate after recording them fully in the books of the purchasing company, and let us not do it before adjusting there. Number 1, debit business purchases, credit liquidator 15 and 15. 2, debit PPE, debit current assets, credit current liabilities, credit business purchases. 15.5, current liabilities 2 and business purchases 15. So credit capital reserve 3. Now let us discharge the purchase consideration, debit liquidator. I am writing it in short because it is fast track. Debit liquidator, credit equity share capital, credit security premium 15, 10 and 5. Correct? So this is 100 rupees, this is 50 rupees per share. Nominal value and the security premium. Item number 4. This is with debit current liability, credit current asset. Mutual owings between them has got to be eliminated. So between them 1 lakh is there. 1 and 1. Item number 5. The item of assets that they have sold and all that you have. Unrealized profit is there, not for the entire 1 lakh, but only for the unsold portion. So therefore, stock reserve, which is given in the problem as 25% on cost, but the other company is holding it at selling price. So stock reserve is 20% on selling price. So 1/5 on 50,000 comes to 10,000. So debit capital reserve 0.5, 0.10. Credit current assets 0.10. So we are expected to prepare balance sheet after this. Now, let us just look into the scheme of journal entries that they have just passed. Yes, capital reserve, liquidator, trade payable, trade receivable. So, capital reserve credits this, and we are expected to prepare a balance sheet. So, balance sheet of BIST, rupees in lakhs. Equity share capital, ₹20 lakhs plus 10 lakhs, 40 lakhs. So, reserves and surplus that I have as 10 plus capital reserve of 3 minus 0.10 plus security premium that I am having, that being 5. So, I got to take 17.90. Then current liabilities 20 plus 2 minus 1, the mutual owings 21. So, 68.90. I have property, plant and equipment 25 plus 15, 40 there. Non-current investments, where there is no disturbance, I continue to have the same old 5. Then current assets I have 20 and 5. 20 plus 5 minus 1 mutual owings minus 0.10 towards stock reserve. So 20 plus 5 minus 1 plus 0.1. So 24.10. I'm sorry, negative. 25 minus 1.1. 23.90. So it comes to 68.90. So now let us just look at the balance sheet. The quickest possible time that we have got to work. So just see, every bit is explained. It is not necessary that you have got to put it in separate schedule and all that. Examination is a place where you have got to give the breakup. Such a breakup, institute cannot present like this, student can do it. So always remember, institute, when they want to make a good presentation, they got to print it like where they will be, or their material will be referred by on a contemporary institutes all over the world, say they print it like that. So you don't do that. It is like an advertisement that is being carried out by professionals there, where they will be jumping from the 10th floor with lot of equipments and techniques and graphical works that they are doing. Say a live person cannot do like that. So therefore, always remember, conceptual understanding is very important. Past journal entries with good narration and all that, though I've just not done there, and give the breakup like this, that is sufficient. Put that rupees in lakhs, don't write like what institute is doing. So many zeros. I just don't like. Even from student times onwards, I just don't do like that. Who is having time to put all this decoration? So we are not like making, what should I say, a presentation like a female going for a marriage reception. She will take more time. So I understand my mom, my sister, my wife, daughter-in-law, all of them will take time. So there is no rush. Even for in the reception, the bride takes more time. 2 hours she took. So in the marriage reception card, they put 6:30. When she came to the floor, it was 8:30. Groom was waiting. Bride was just taken time. So they have lots of time in the world because that is their day. You can't scold. A teacher can scold why the student is late. Nobody will scold. So just, we don't have that much of time. It is not our marriage day. So therefore, try to reduce as much of time possible through your own techniques. So all legitimate things will be permitted. So therefore, this particular topic is getting over. Internal liquidation of companies. So major portion over. Now, when we have before us, banking company and non-banking financial companies are very important. So we have around 45 minutes time, and we will spend our time on banking and non-banking financial companies. With that, we will derive overall satisfaction that we have touched all the topics. Okay. Now, let us just know about the special features of banking system. So a banker accepts deposits and lends money. So here he has got to pay interest. Here has got to generate income through interest income. Here he will be following accrual system. Here he will be following both cash system as well as accrual system. Why? Because the lendings may turn bad, may not be generating adequate amount of income. So the lending will take a beating. So where you classify them as performing assets and non-performing assets. So what do you mean by performing assets? Advances that generate adequate amount of income. What is that? Adequate amount of income. Adequate income as per the prescription given by RBI from time to time. So NPA is not bad, which will have inadequate income. Inadequate income. What is adequate and what is inadequate? RBI will decide from time to time. During COVID times, they have just made some relaxation. Post-COVID, they had some amount of relaxation continuing, and after that, now more than 1 year had passed, we are almost on to close to 2 years. So we do not have the same norms. So norms will change from time to time. So we don't have to mug it up regarding what is the norm. So basically, we need to know that assets are to be classified, which you call it out as advances that are lent, where you classify advances into performing asset or non-performing asset. Non-performing asset sub-classification we do have. So that being non-performing assets, we have as law. There is this last one is loss asset, which you call it out as standard asset. So you call this as substandard asset, substandard, and doubtful, and lastly you call that as loss assets. Okay, so when you have standard assets, doubtful assets, and loss assets, for these items, income will be recognized only to the extent of cash collected towards interest. So therefore, we say it is cash system of accounting. Accrual for standard, and just like any other commercial enterprise where you have provision for doubtful debts, here also we do have doubtful debts. So provisioning aspect is what we have to take up. Provisioning. So provisioning, normally we will put it only for NPA, but do not be misguided regarding this provision. So that no provision is required for performing assets. It is not like that. So provision is there even for performing assets. So you have provision for non-performing assets. You have some nominal provision made for performing assets. People might ask, when it is performing asset, why do you just require it? So please always understand that a banker is expected to take securities, the property or whatever security that they may be providing, security may be inadequate. So first one, it could be adequate and it may be inadequate. Despite the asset may be underperforming assets. It may be a performing asset, but securities may be inadequate. So it might come in that particular category. So therefore, we require provision. So I will put it this way: security wise, they are adequate. Security wise, they are inadequate. See, I'm telling you the background. I'm not solving the problem within the short span of time. So if you know the background, you can easily understand any question. So here it is performing asset. Here it is non-performing asset. So adequate security, adequate income. So no provision is required. Adequate security, NPA, security is required. That is, provision is required. Provision is required. Inadequate performing, provision is required. So inadequate, non-performing, provision is required. So therefore, accepting this particular case, in all other cases, we require provisioning. So it becomes very difficult to identify individual items and then provide. So therefore, we will provide even for performing assets a nominal provision is done at head office level. At head office level, and it will not be done at branch level. So where banking is operated with lot of branches across the country as well as across nations. Now, let's just go through one by one those items. Now, let us just take up there is books of their firm, books of a partner, there is a banking company, and let's know about their financial statements. See, a lot of technical terms that we have got to be knowing about that. Now, let us just know about how a profit and loss account will look like, how a balance sheet will look like. So, this is the revised format, third schedule C, section 29, form A, form of the balance sheet. So, where you have capital as how money is raised for the current period end as well as for the previous period end. Reserves and surplus and deposit is the main source of funds. So, therefore, immediately after capital and reserves and surplus, you have deposits, then you borrow money. So, a banker will also be borrowing money from RBI and with other banks. And then for meeting some of the expenses, they would not have paid at the year end. So, those other liabilities and provision. So, only 5 items that you have on the liability side, whereas you have 6 items on the asset side. Cash and bank balance, cash and balances with RBI as schedule 6. Balance with bank and money at call and at short notice, schedule number 7. Investments 8. And why these items are coming in the top is that because a banker is expected to discharge all his obligation at once. That is the reason as why you say as bank. So where you can really bank them, that means you can have real trust. So you have statutory liquidity ratio, cash reserve ratio, all that. Let us assume that the banker is having adequate amount of money and according to the norms that they have invested. So therefore, in the order of liquidity only, they have just kept it. And if you look into the real source of income, advances would be the real source of income, but it comes number 4. So it is all like Virat Kohli, who is real run scorer. He may not come in as the opener, but he would be coming as the number 4 batsman. So second down batsman. Likewise, you can consider advances is the big source of income for the bank. Then comes fixed assets, where the bank may be owning, and there could be other assets which may not be considered to be under fixed assets. Then we do have something called as contingent liability. So when banker is operating with lot of borrowers, so borrowers will have some problems with the bank and bank may have problems with the borrowers. So there will always be litigation on either side. So who is right and who is wrong, we are not going to discuss. But we will be taking into consideration lot of such contingent liabilities. So where It may be a case against the bank not acknowledged as debt. Amounts may not be clear, and there are a lot of AS-29 matters will also be there. Bills for collection. So in the old format, prior to this particular format, we had bills for collection and bills for payment as contra items appearing on either side of the balance sheet, which is a matter for there is a reader's understanding, which they were having it on either side. Now that they have decided not to have it, and it is to be there as a part of footnote. And now let us just have a look at our profit and loss account, where we have only two items on either side: income, interest earned, and other income. What could be other income? A banker may just take up for commission, brokerage, etc. For any dealing. When you want a demand draft to be taken, they take commission. When you have a forex dealing, they just take brokerage. So all that will, and locker rent, they are just charging. All that will come under other income. So interest earned is the main source of income. Other income, incidental interest expense is the main item of expenditure. Operating expenses would include rent payable for the premises that you have taken, salaries paid. These are the two major items that you would be having. Then provisions and contingencies, that we will be having three items on the expenditure side, and this may result with profit or loss, and we are expected to transfer to statutory reserve. So RBI will also be just making those amendments at various points of time, and to other reserves, and transfer to government and to be carried forward to balance sheet, and that's a way that you have got to close it. And just like in any other case, you need to have notes to the accounts. And now let us just proceed and look into a problem, at least as how the problem can be solved. So in fact, here we do not have a problem given. It is purely a theory portion only. Now let us just complete that. See, one very important thing that we take up in banking is income recognition, classification, and asset provisioning and all that. So that is going to be a point of good learning. Income recognition, as I told you, that we do have income recognition. See now, whatever example that I've just given, we will see them in the form of solution. Though I will not be doing a problem that, but we will discuss that. So performing assets, interest earned on interest received, and NPA, interest earned and interest received. So find out the income to be recognized. So in the term loan, 120 you have, 80 only you have received, 750 you have earned, only 620 you have received. Bills payable, bills purchased and discounted 150 and 150. Of these two, which one to be taken up? Now let us just have a look at interest on term loan. So it is 120 plus 5. I did tell you, for performing assets accrual system, though they have received only 80, but 120 we have considered. For cash credit, similarly, whichever is higher is what you got to take up, and whichever is lower is what you got to take it up. So, and 150 plus 20, and that is the way 1057 is what we have taken up. So I wish that this problem is coming to the main examination, maybe for 2 marks, 3 marks, or 4 marks. So please be careful. So same is the way the next one. Now let us just take up. If there were to be anything else that we can take it up, we will just push it across. See, here is a place where I was just telling about performing assets, standard assets, non-performing, substandard, doubtful and loss assets, and how they are to be termed. So they have given you the norms. So the norms might be changing from time to time. So please be careful. Provisioning aspects, all of you, please just pay a lot of attention to this provision. Substandard, 15%, and unsecured exposure 25, and when you have that for infrastructure loan, it is 20. Doubtful assets, unsecured portion, any unsecured portion will always be 100%. So always remember that, because you don't have anything to lean to catch on to the money that you have given. So once it is lost, it is permanently lost, because nobody will have the tendency to pay, because the business may be under severe strain. So where you would be finding a lot of other creditors who would be finding their rights to be, what should I say, presented, and they will also be fighting. See, when provision is made 100%, it is not that bank is writing off. So to that extent, my income is getting reduced. That's it. See, many are under the wrong impression that 100% provision would mean it is written off. No, it's not like that. In my income and expenditure, that provisioning in which I am reducing so much as my expenditure. Have that in your mind. Now let us just take up illustration number 2. From the following information, find out the amount of provision to be shown in profit and loss account of AG Bank. So standard. For standard, what is the rate that we are expected to apply? So for when it is standard, see here they have mentioned 0.25% and 1%. So with MSME coming into operation, what is that we should do? For all other loans and advances not included in above, which is 0.4%. So have that in your mind. We have got to be very careful regarding what type of standard assets. So as far as MSME is concerned, the provisioning rate is expected to be on the lower side. So now let us just see, which is 0.25, because the government is protecting in many forms MSME because of the classification change. So the default size had just come down against MSME. So therefore, when they are very well secured, you don't have to create a much higher percentage. For namesake, namke vaste, we are expected to just provide that. So when nothing is mentioned as what type of asset it is, so 0.4 is what we have got to take up. Just see 0.4. Substandard 15%, doubtful for 1 year 25%, and for 3 years it is 40%, more than 3 years 100, loss 1000. So that way we are expected to have that. So here to illustration number 3, standard 0.4, all other items 15, 25, 40, 100, 100 and 100. So therefore, so provisioning is that is the place where they just take up. Now let us just take up on to when you have export credit guarantee corporation securing the amount of loan. See, it is not necessary that they should be giving the asset. If there were to be an insurance company, or if there were to be some other entity which will be doing that operation, definitely that security should also be taken into consideration. When you have outstanding balance to the extent of 4 lakhs and the security what they are providing is 1.5 and 2.50, the Export Credit Guarantee Corporation is covering up to the extent of 50% on the balancing figure, not on the entire 4. So 1.25 and unsecured portion is 1.25. Any unsecured portion will always be taken up at 100%. Then provision for secured portion of advance is 1.5. This is for 1.5. So therefore, we are expected to have 100% of the secured portion as remained advanced, as remained doubtful for more than 3 years. So therefore, 100% for the unsecured portion and 1.5 even though it got secured, because they have mentioned that it was there for more than 3 years, and therefore the total provision is to be taken up for 2.75. You've got to be very careful. Mark illustration number 4, 2 marks to 4 marks. These sort of questions when they ask, let me tell you, many students will take up 1.25 only. They will forget to apply on the secured portion alone because of the fact that it was there for more than 3 years. They may forget it. So please be careful. 2.75. Now let us just take up here also you have that. So for 1.5 also you have to take up, and so for 80% of 1.5, here realizable value only to the extent of 80%, whereas realizable value here they have not mentioned anything. Please be careful. A small variant might change our life. So please be careful. Don't forget all these are tricks played on us. We got to be very careful, and we have got to be very much alert. So therefore, 80% only we should deduct, and 50% covered, other 50% not covered. The uncovered portion for which it is 100%, and we are expected to apply 100% of the secured portion for more than 3 years. So 2.6 lakhs is what we have to take up. So all those items I expect you people to try. So we have 5 more minutes before us, and let me just not cramp it by taking up a topic that way. So I would just use this time to cool you down and ensure that you apply your mind in a very, very soft manner. So people not be asked, which is very important and all that. I would say important topics are three in numbers. Three, anywhere, whether it is a work or whether it is an examination. So I just learned this from our president, ex-president of CA Institute, Padma Shri, Dr. T.N. Manogaran. He was just telling in one of the meetings where I was also a member attending. Wonderful speech he had given. So I'm just borrowing his idea and putting it out here. What is that? Where you have to consider most important, moderately important, and less important. So you can say you have to know everything in something. All type of problems you should be in a position to solve. Most important. You can never miss any item. Here, most of the items one should know. What do you mean by most of the items? So important areas where you say it is frequently asked, those items are most of the items one should know. You should know something in everything. So here everything in something, something in everything. So you should not be just telling Singapore is in Sri Lanka. You neither know Singapore nor Sri Lanka. At least a geographical understanding you should be having. A bird's eye view, a macro aspect of everything you should be knowing. On the other day, when I was just talking to a new client, he was just telling something technically. So where I did not understand for a moment, then I understood, okay, what he is just talking about. Towards the end, he was just saying, sir, it's surprising that you do not know technically. I got to accept. Yes. Every day is a learning experience for me. I'm learning. I have learned the next day to such an extent, I gave some updates to him. Then he did not accept that I did not know the previous day and I learned one day overnight. Because I felt really insulted on that day and I just worked and searched, Googled, thanks to Google God. So likewise, you just, and YouTube also, use your time and work out in such a fashion that you clear with, you keep the standard as 90%, don't keep 40-50. So utilize your time and do very well. And all the very best. I would like to address you people for a final CA final session. And thereafter, I want to address you as a chartered accountant. Thank you. All the very best. God bless you. Say, my dear friends, so please just close it.